Thank you for joining our monthly recap of the month of August. Michael and I are going to review a couple agenda points and look to what's ahead. So with the month of August, we've continued to see the last few months of this 1 week where growth outperforms, 1 week where value outperforms. And it was basically the same the month of August, where every other week we saw a similar trend. Although toward the end of the month, you really saw an acceleration back toward value names in the strongest trading we've seen since May. So it'll be interesting to see as we look into September if that trend continues overall.
Yeah, and JR, to your point, August markets did hit fresh all-time highs. And when you look at kind of the reasons behind that, aside from the Fed printing as much money and putting it into the system where it needs to go somewhere, you had unemployment claims dropped at a pandemic low. You had wages that were increasing, and you also look at GDP. On the total GDP number, we're now higher than where we were pre-pandemic. So, question is really, are we back? And if you look at the Fed and what they said at Jackson Hole, the answer is kind of yeah. They said that they'd start tapering their asset purchase program probably towards the end of this year. And when you look back at the 2013 taper tantrum, markets actually fell on that news, but then recovered. But upon this news, markets just continue to rally. You would think that tapering the balance sheet would bring some negative sentiment to the markets, but can you explain why we didn't see that, JR?
It's interesting, Michael, because you're right on. Historically, and especially taper tantrum, that's exactly what happened. The markets fell, and it feels this time you had a lot of Fed governors ahead of the speech by Chairman Powell, kind of getting the markets prepared for that tapering. However, when Powell did speak, it was a very muted version of tapering. And I think what the markets really focused on was interest rates, where he said, we're going to look to taper by the end of the year, but thinking about raising interest rates is much further behind that. So it really pushed a lot of the expectation of interest rates going up, probably into 2023 at this point as we sit here today, and the markets seem to like that and rallied to new highs shortly thereafter.
And as we look at sort of another area of just the economic health, we look at specifically at the consumers. So as we said before, right now the consumers are in good shape. Unemployment is down, wages are up, and you think of areas that should benefit. One of those areas should be retail, you would think. And as we kind of look at the way we've been spending lately, whether it's the Delta variant that's been increasing, you're seeing more people kind of pull back on going out as much, and you're starting to see more online sales again. And I think it's important to look at companies that have been successful in pivoting to online sales from their brick and mortar and have been able to sort of go back and forth between the two. And it just seems that, those are the companies that have really, should be able to see a boost from any type of change in consumer sentiment.
And retail earnings across the board were awesome, right? I mean, they really blew away expectations across the board because consumers are flushed with that cash. And we continue to like the consumer and exposure in that area of the marketplace. It's just going to be a little more selective as we enter the fall because the foot traffic, because of Delta and other things, has gone down. So the companies that had the online presence have grown. That margins have been fantastic, and there should be continued upside in much of the retail space.
And outside the retail space, I do want to talk about commodities and materials for just a moment. We've seen some volatility within those names recently, but based off of infrastructure, the infrastructure plan, continued demand for housing, and then with some of the natural disasters we've seen lately, that I think you'll continue to see demand there. Obviously, we wish that these disasters weren't happening, but when you look and to see how markets have historically responded to them, it seems as though some of these areas, whether they're the materials companies, supply stores, that they have tended to see their demand increase as you have to rebuild homes, rebuild infrastructure, and put these towns and communities back together again.
And to your point, we were at historic demand for a lot of these commodities before some of these natural disasters and the infrastructure bill. So it looks to be a lot of these areas, which tend to be mid and small cap companies, should have a lot of benefit in the quarters and really years ahead as all that demand kind of comes to fruition.
Mm-hmm. And Jer, how do you feel about sort of banks and financial companies right now?
The financial sector has been a great place to invest. We really invested much more last October after the bank earnings, because the markets really felt that was the peak quarter for earnings at the time. And the reality was there was a long way to go with the benefit of hindsight. As we look here today, ahead, the M&A activity overall has been strong, but we think there could be a lot more activity because the bigger companies, we believe, as you hit this cycle, tend to buy their growth. And the big banks tend to benefit from a lot of that merger and acquisition activity. On top of, with markets at all-time highs, advisory fees and other things are very high. And then you couple that with interest rates likely to trend higher as the Fed tapers. The financial sector has done well, but the valuations remain very cheap. So still see some pretty good opportunity in the financials.
And I do want to hit on one point that you mentioned, that companies are looking to really buy their growth now. And you look at what's really going to move the needle for them. It seems as though if you're a big mega cap company, buying a company that's only a couple $2 billion in market cap really isn't going to do much for you. But when you look at some of the more mid-sized companies that have where you're looking at 10, $20 billion in terms of an acquisition cost, that those are the types of names that really can have an impact for these larger companies. Do you think that makes sort of that mid-cap sector more attractive?
Absolutely. And you look back to the last huge wave we had over a decade ago, and that was exactly the logic that many companies followed. And the other thing to look for is private equity is sitting on record amounts of cash. A lot of them don't like the valuations because the valuations are high, but interest rates are low. So as you look, you're likely to see a lot of that cash on the sidelines from private equity come to have buyouts. And those tend to be in the small to lower end of mid cap. So I think there'll be two tiers of opportunity where you don't have big companies merging with each other, but you have big buying smaller. We should see a lot more of that in the quarters ahead.
Okay. And I guess from our own, for our own team, for our own clients, we've actually been looking to take profits and take some gains for the first time in a few months recently. And looking ahead, whether it's what's going on with Congress, the infrastructure bill, the budget, you've got unemployment benefits rolling off. We do think that it's prudent to have a little bit more cash, and we've been looking to, again, take some gains as we look for more opportunities for moving forward.
Yeah, and that's right. We think it's prudent at this point. We're not super cautious overall, I would say, but as we look to September and October, which are historically more volatile months anyway, and you couple that with the outlook of the Fed tapering, that is going to be a negative for the markets at some point. But we believe as you look out a few quarters, the strength of the economy and a lot of that will override that, which is the good news why the Fed's even considering tapering, is because we are in such a strong position overall. It just will create at some point some volatility in the markets. So we think having a little bit of cash to selectively buy into what might fall more than others, or depending on where the consumer and everything falls into October, that there'll be room to buy overall. So with that, we want to thank everyone for listening, and we'll touch base next month.
All right. Thanks, Jared. Thanks, everybody.